These iTunes talks intend on touching on many of the key elements or topics of your course. The narrative is provided by me, your instructor. However, they cannot cover the full range of topics in your textbook. So, they are not a substitute for your reading of the assigned text. Learning accounting is a multifaceted process. Reading about a topic, checking out handouts on the subject, listening to key explanations such as these iTunes talks, and asking questions to your instructor. It's important to review the textbook before attempting assigned homework. Homework is intended to do three things. In addition to your obtaining grading points from it, homework reinforces what you've learned. It allows you to apply concepts. You can identify a knowledge gap in your understanding, which may require a retake, and it allows you to practice what you've learned, since practice is the key to retention. Your use of these iTunes talks and other publisher material contained within the MyLab software can be an excellent basis to ask me questions about specific topics. I believe it's virtually impossible to effectively learn without asking questions. The only question I don't like is the one not asked. Chapter 1, Accounting and the Business Environment. Here's the first three learning objectives of the chapter. Explaining why accounting is important, describing organizations that govern the accounting profession, such as the FASB, Financial Accounting Standards Board, the rulemaking body, and describing the accounting equation and defining its three components: assets, liability positions, and equity positions. Don't let the brevity of the accounting equation deceive you. Its three categories can accommodate every transaction we can throw at it. Learning objectives 4, 5, and 6 use the accounting equation to analyze transactions, preparing financial statements, and then using financial statements and return on assets to evaluate business performance. Of these three, number 4 is extremely important in Chapter 1. Use the accounting equation to analyze transactions. All equations are two-sided. In the accounting equation, there's only 4 conditions, therefore, to keep it in balance. Either we increase both sides by the same amount, or we decrease both sides by the same amount, or we have a plus and minus on one side, zeroing it out, or a plus and minus on the other side, zeroing it out, so only one side of the equation may be affected. Your task in Chapter 1 is to see which movement or change in the equation is represented by individual business transactions. Do not leave Chapter 1 until you begin to see how the values of the equation ebb and flow to the rhythm of the business cycle. So let's start out with the purpose of accounting. The purpose of accounting is to identify, record, and communicate economic events. We call these transactions. As we can see by this slide, there are several users of financial statements, both internal and external. Each party is interested in the financial health of a business. This is the end product of accounting, to communicate financial reports to these users to allow them to assess the financial health of a business. Users can raise various questions, and obtain the answers that they are most interested in by reviewing financial statements. The last sentence of this slide here says it all. Effective financial reporting depends on sound ethical behavior. When there's a lapse in ethical behavior, there can be misreporting of corporations that can lead to bankruptcy and lawsuits against the board of directors and others. All of these options. As indicated, ethics is a fundamental business concept which, when not followed, results in financial statements which are misleading. Generally accepted accounting principles is the term GAAP that's given to the underlying rules that accountants use to develop financial statements such as the balance sheet, the income statement. Failure to follow GAAP results in statements that are not in compliance and therefore may be misleading to users of financial statements. Certified public accountants, one of their primary functions is to attest to the fair presentation of financial statements according to generally accepted accounting principles. There's various sources of GAAP. The SEC in the U.S., the Financial Accounting Standards Board, FASB in the U.S., and also the International Accounting Standards Board in London. The last two bodies, the FASB and IASB, are separate setting bodies who are converging and merging their principles as we currently speak. Two important accounting principles here. The cost principle is very important. As we acquire assets, we record them at our historical cost. A logical principle, but one that must be followed. The two assumptions here, the economic entity assumption requires that all the activities of an entity be kept separate and distinct from the non-business activities of its owner and other economic entities. What this means is once an asset comes into a business, that business takes control and ownership of it, not the party that contributed it. If an owner contributes assets when starting out a business, the owner may have a claim against those assets, but they are under the control of the business entity itself and no longer the owner that contributed it. Various forms of business ownership, proprietorship, partnership, incorporation will be primarily concentrating on sole proprietorships, the first one. Near the end of this course, the last chapter, we'll talk about corporations and the impact on accounting. We have two separate companies here under different management, and they're not related. If we combine those statements, we'd be violating the economic entity assumption. Two entities that are not related should not be combined. The corporation here is the form of ownership that we'll look at the end of this course, the last chapter. This presents the basic accounting equation. In a live class, I often like to introduce this first by proposing the following equation. What on the left equals y on the right. What are the assets? The y on the right explains why assets come into existence. This equation provides the underlying framework for the recording and summarizing of all economic events in the business. The important thing is to remember that assets or wealth on the left and claims to wealth on the right are two separate concepts. They should not be confused. Emphasis on assets being the resources of business owns. That's how it operates a business, how it conducts its affairs, brings in sales, etc. A liability is a legal claim against those assets. For instance, companies may sell assets on credit to a business, and until that claim is paid off, the creditor would have a liability claim against the corporation or business. The owner's equity is a residual claim, meaning that it's not a legal claim. It's strictly defined by assets minus liabilities equals owner's equity. This equity section or category of the equation is extremely important, and one that students need to spend a fair amount of time on in this first chapter to understand the type of events that we collect under owner's equity. We do a lot of reporting out of that section of the equation here. It's important to note that owner's equity does not list any assets. There are no accounts in owner's equity that are asset accounts. All the asset accounts appear on the left-hand side. The basic accounting equation on the top, assets equals liabilities plus owner's equity, morphs into an expanded equation primarily when it comes to the owner's equity area. There's lots of activities captured under owner's equity, and we'll discuss those shortly. A key term, revenues. What's a revenue? It results from business activities entered into for the purpose of earning income. Common source of revenues are sales. The reason a business exists is to make sales. On the other hand, expenses are the costs of doing business. They measure the cost of assets that are consumed as a business engages in the earning process, such as salary expense, rent expense, utility expense. What's occurring here in the equation is as cash is used, for instance, to pay salary expense, cash on the left, assets, is reduced, and therefore something on the right has to be reduced, in this case, owner's equity, through expense accounts. As mentioned, the equity component of the equation is very important. It represents the recorded net worth of owners, increased by the owner making investments and revenue activities such as sales, and net worth is decreased by the owner withdrawing assets or making a divestment or expenses of the business. I'll make an obvious statement. The owner obtains the fruits of his labor, revenues or sales as they come in, but the owner also has to bear all the cost of operating the business, expenses, and so it's the net of those revenue versus expenses, or net income, that accrues to the benefit of the owner over time. As an understanding aid for the equation, I use the example of the aloe vera plant. You will not find this in the chapter. The aloe portion is simply the asset equals liability plus owner equity. That's simply memorized. And all that takes is less than 10 seconds. It's the second portion of this memory aid, this mnemonic, Vera, that's the key to this particular aid. Vera, V-E-R-A, represents the 4 owner-directed business activities that affect their net worth. Now, the reason I present this understanding aid is primarily the equity section, which can be confusing to many students. There's lots of activity occurring under owner's equity. The owner's equity area is a measurement of the assets coming in or going out of the business. The V stands for investments by the owner, which increases net worth. What's occurring here is that if an owner contributes cash, cash is coming in on the left-hand side of the equation under assets, and we measure that increase in assets by an investment account on the right-hand side under owner's equity. As expenses are paid, it decreases the net worth of the owner. Effectively, cash may be used to pay salary expense, so cash is reduced on the left, and we reduce owner's equity on the right by use of an expense account. Revenues of business increase net worth. Revenues reflect the fact that assets have come in due to a sale, cash may be increased, or an item such as accounts receivable, which is also an asset, a credit sale. So on the right-hand side of the equation, we must mirror that and reflect the revenue account that shows the growth of the net worth of the owner. The A, all else, takeaways, decreases net worth. Owner divestments. Example, an owner can withdraw cash. Cash is reduced on the left, and we reduce the equity of the owner on the right by use of a drawing account. Owner investments are recorded directly to an owner's capital account. This is a permanent account. It increases the claim they have on the total assets of the business. All other equity activity, measured revenue, measured expenses, or measured drawing activity are recorded to separate accounts to facilitate reporting later on, such as the income statement. We want a lot of detail in the equity section for reporting purposes, and hence we have separate accounts for revenue, expense, and drawing. Later we will see that those accounts, revenue accounts, expense accounts, and drawing accounts, are closed out or zeroed out at year-end only into one account, which is the owner's capital account. We'll cover that in a subsequent chapter. As indicated, transactions are business and economic events recorded by accountants. Not all activities represent transactions, but when we do record a transaction, they're recorded under the rules of double entry accounting. Not that the transaction is recorded twice, but the one transaction, the single transaction, has a dual impact on the equation. All transactions are recorded under the context of the accounting equation. Here's some sample transactions, some events, to determine if they should be recorded in the books of a business. The first event here, supplies are purchased on account. The key criterion is the financial position, is the status of assets, the status of liabilities, or the status of the owner's equity position affected. The first case, the answer is yes. We'll record supplies purchased on account. Supplies are an asset. They'll go up on the left-hand side of the accounting equation. And a liability account on the other side, such as accounts payable, will be increased on the other side. The second event, an employee is hired. That in itself does not affect financial position. It can be a very important event in the life of a business, but it's not recorded in the books. It does not affect the asset, liability, or owner's equity position. The third event here, owner withdrawing cash for personal use. He's taking cash out of the business. That would be recorded. Cash would be reduced on the left and reduce the owner's net worth, the equity section, on the right-hand side of the equation. So that'd be an event that's recorded as a financial transaction. Now, the following dozen pages or so are very important. I want you to pay particular interest to transactions affecting the equity section, the right-hand side, one of the elements on the right-hand side of the equation. We'll be looking at what's called a tabular analysis, which simply shows various assets on the left and the two parties on the right, creditor and owner, and how transactions are affected within these elements. Remember, the right-hand side of the analysis corresponds to the right-hand side of the equation, and the right-hand side represents two broad parties that are responsible for changes in total assets, either increases or decreases. Those two parties are creditors and owners. Creditors represent parties that we legally owe a debt to. Owners, their net worth position is a residual or remaining claim once all liabilities are subtracted from assets. It's important that you understand that the elements, liabilities and equity, on the right-hand side of the accounting equation are claims on assets. They are not the assets themselves. A prime example, if you own a house that has a mortgage, the mortgage would be a claim against the asset. Here's what's known as a tabular analysis. We've got the accounting equation, assets on the left, and various assets listed under it, cash, accounts receivable, supplies, equipment. They all are resources a company has to conduct business. Cash is self-explanatory. Accounts receivable is a promise of a customer to pay later. That evidences a sale is made to a customer on account or on credit. We record the sale when it's made, and later when the cash is received, we'll record the increase in cash and decrease in receivables. Supplies represent items that will be used in the future, and equipment is a long-term asset that will be in business for several years. The other side of the equation, liabilities and owner's equity categories. We just have one account here under accounts payable as an example. Typically there are several payable accounts. Any account that ends in the word payable indicates a legal debt or obligation that's owed to an outsider. The owner's equity category, as you can see, is broken down into the 4 categories. The owner's capital account, which will measure any assets the owner contributes. Owner's drawing, assets that the owner takes out of the business. Revenues or sales, assets coming in due to the sales activity. And expenses, as assets are used up in the pursuit of sales, they reduce the owner's equity category. Again, the owner's equity category, these 4 areas here, investments, expenses, revenues, and takeaways, are different activities, and you should study the owner's equity area carefully so you can map out these changes as they occur. So the key in this tabular analysis is assets on the left, as they increase, we'll have to increase something on the right-hand side. When assets on the left decrease, something on the right will have to decrease. We can have examples where we'll use one asset to acquire another asset, so in total assets don't change and we don't have to affect anything on the right-hand side of the equation, only on the left. So the first transaction is here. The owner invests $15,000 of cash to start a business. This is the V, or the investment action of an owner. The transaction is recorded as an increase or a plus to cash. Cash comes in to the business, into the control of the business, and it's the result of the owner investing, and so we'll increase the owner's equity or owner's net worth under the owner's capital account as indicated. Again, all transactions are recorded in the context of the equation. The equation must stay in balance after all transactions are recorded. The cash is an asset on the left. The $15,000 owner's capital is a claim against assets, not the asset itself. Double entry accounting. Not only what did we acquire, but why did we acquire it? Second transaction, the business uses $7,000 of cash to purchase equipment. In this case here, we're just going to exchange one asset for another, use cash to buy the equipment. And so therefore cash is reduced, negative, and equipment is increased, positive $7,000. There's no change to assets in total, so therefore there's no transaction to be recorded on the right-hand side or the claim side of the equation. In this third transaction, the company is purchasing supplies from an outside supplier. The purchase is made on account. That means it's on credit. They'll be paid later. Businesses operate on credit quite commonly. In this case here, they're going to indicate they're going to record the increase in supplies before they pay for them. The terms of the purchase will dictate when it's paid. Commonly, purchases on account are made on 30 days or 60 days, meaning that cash will not exchange hands until 30 or 60 days later. But in this event here, the financial condition is affected. The business has acquired supplies plus $1,600, and it's also acquired a debt or obligation to pay these supplies later. Accounts payable on the other side of the equation is increased by $1,600. So we have assets increasing, and we have the liability position increasing. The equation stays in balance. In the fourth transaction here, the company receives $1,200 in cash from a customer. This is a sale, and in particular, a cash sale. How's it going to be recorded? Let's first record the what. Cash goes up by $1,200. And on the right-hand side of the equation, let's explain why cash went up. We'll increase the revenue account under the owner's equity category. So here we have the right-hand side of the equation explaining why cash went up on the left-hand side. In this fifth transaction, the company receives a bill for $250 from the local newspaper for an advertisement that they placed in it. Payment of this bill will occur later. The question is, when should we record the expense? And the answer is now, when it's incurred. So we'll record a reduction in owner's equity of $250 under expense category. We haven't paid cash for this yet, but we've incurred a debt or obligation to pay it later. So under our liability section, accounts payable, we'll increase that by $250 to offset the negative $250 under expense. In total, nothing has changed the right-hand side of the equation, therefore there's no action on the left-hand side. That will occur later when we extinguish the debt. When cash goes down, we'll reduce accounts payable, and we'll see that in a separate transaction. The key here is that we record an expense when we incur it. And paying off that liability later will be a separate but related transaction. Again, fully balanced. Transaction number 6, the company provides $3,500 of programming services to customers. It's made a sale here. Now this sale is a part cash sale and part credit. So we made the sale, we're collecting $1,500 from the customer immediately, and the balance will be paid later according to the terms of sale, whatever that is, 30 days, 60 days, whatever's agreed upon between the company and the customer. How's it recorded? On the left, we received cash of $1,500. It's increased. Accounts receivable is increased by $2,000. Again, this is a promise of a customer to pay later. This is an asset. So we have a total increase in assets of $3,500, and we explain that on the right-hand side of the equation under the revenue account. The owner has the benefit of all revenues just as they fund all expenses. Transaction 7, SoftBite, the company here, pays the following expenses in cash for the month of September. Store rent, $600. Salaries of employees, $900. And utilities of $200. Now these are logged separately. As you'll see later, we want the detail to appear in our income statement. And so therefore, we have individual line items here for each expense. Again, here's an example of using assets in the conduct of business. Assets are reduced on the left, and we're reducing owner's equity through expense accounts on the right. In transaction number 8 here, the company is paying off its $250 advertising bill to the local newspaper. This may be paid off 10 days later or 30 days later. It's not specified here. The point is, though, that we're paying off the liability we previously established. Looking up in transaction number 5, we can see that we established a liability of $250, and now it's going to be reduced and cash will be reduced. So liabilities on the right are reduced and cash on the left or assets are reduced by the same amount. Again, the equality of the equation is kept intact. Note that we don't just record expenses when we pay for them. There can be a lot of cash expenses which are paid upon incurrence. In this case here, we incurred the expense before we paid off the bill. Two separate but related transactions. In transaction number 9 here, the company receives $600 in cash from a customer who previously was billed for services in a prior transaction number 6. This was a credit sale previously, and now we're collecting a portion of that credit sale, not the full amount. So we're going to reduce our receivables by $600 and increase cash by $600. This has the effect of no change in assets in total, so therefore there's no entry on the right-hand side of the equation. This is a partial collection of a previous credit sale. In this example, we have another $1,400 which is owed to us, which remains on the books and will be settled whenever the parties agree. Transaction number 10, Ray Neal, the owner, is making a withdrawal of cash, $1,300 from the business for his personal use. He's taking assets out of the control of the business to put them back in his own personal pocket. So we reduce cash by $1,300 on the left, total assets are reduced, and we explain that reduction of assets on the right by reducing the owner's equity account through a drawing account. This next slide just brings down the totals of the cash, accounts receivable, supplies, and equipment assets, ending balances, and the ending balance in accounts payable. The owner's capital account, the owner's drawing account, revenue accounts, and various expense accounts. If we add up the individual asset accounts, it totals $18,050, and that equals the individual balances in all accounts on the right-hand side, $18,050. If at any point in time our total assets is not explained by ending balances in liability accounts or owner's equity accounts, there's been an error that's occurred and it must be traced down and rectified before continuing. Stepping back, what's happened here in the transaction analysis? We've recorded economic events, transactions, as the affect financial condition, either increasing or decreasing financial condition. That is, were there changes to asset accounts, liability accounts, or equity accounts, all contained within the accounting equation. In a separate handout for this module, I've defined 5 recurring economic cycles and their impact on the accounting equation. These 5 cycles all involve assets, getting assets, rearranging assets, using assets up, creating new assets, or returning assets to owners. This is the dynamics of the accounting equation which you need to understand in Chapter 1. Getting assets, assets will be increased on the left, and on the right, one party, creditors representing liabilities, or the owner, owner equity, one of those positions will be increased to explain why assets have increased. The second line indicates use of cash, for example, in buying a building. There's just a change in the mix of assets on the left. Total assets does not change, so therefore there's no impact on the right-hand side of the equation if total assets have not gone up or gone down. The third line indicates an example of an expense payment. Let's say using cash to pay salaries expense. As cash goes down and a minus on the left, the owner's equity position goes down through the use of an expense account on the right. The fourth line indicates the creation of an asset, such as a sale. Cash may be increased, or accounts receivable, which is an asset, may be increased if it's a credit sale. So as assets go up on the left, we explain that by increasing owner equity on the right, in this case by use of a revenue account. The fifth line indicates a withdrawal of funds by an owner, assets going down, and owner's equity going down through use of a drawing account. What I want you to note is that the equity section can be impacted in 4 of the 5 economic cycles. This right-hand side of the equation is mirroring changes on the left-hand side. And we do a lot of reporting out of the equity section. For example, the income statement and equity statement, the first 2 financial statements that are shown in this chapter, are done all out of the account detail under owner's equity. That's why it's extremely important to understand what goes on in the equity section. Here's a recap of the 4 financial statements introduced near the end of this chapter: income statement, owner's equity statement, balance sheet, and statement of cash flow. The income statement is simply a measurement of why assets change due to the profit-seeking activities of the company. The owner's equity statement is a broader statement that incorporates the income statement, but brings in 2 other reasons why the owner's net worth or the owner's equity may have changed, such as new investments by the owner or withdrawals of assets by the owner. as mentioned previously, it's the needs of these two statements that there's a lot of individual accounts under owner's equity, several accounts, especially many expense accounts. Companies want to understand why they've had net income or net losses, and therefore it will set forth and classify expenses separately, such as salaries or rent, and therefore most of the accounts under owner's equity will be expense accounts. Question: net income will result during a period of time when assets exceed liabilities, assets exceed revenues, expenses exceed revenues, or revenues exceed expenses. The answer is D, when revenues exceed expenses. The income statement is a series of revenue accounts, maybe just a few, and several expense accounts. They're not the asset itself, but they reflect reasons why assets have increased. That is, sales revenues, new assets created through a sale, have exceeded the cost of doing business or expenses. Now, all four financial statements are interrelated. We'll demonstrate this in the next several pages. Again, the income statement is developed first, then the equity statement. Both of these all come from accounts within the equity section on the right-hand side of the accounting equation. Then the balance sheet is developed, which is the accounting equation itself, assets equals liabilities plus owner's equity. It's just the ending balances in all asset accounts, the ending balances in all liability accounts, and the ending balance in the owner's net worth position. And lastly, the cash flow statement is prepared. Here we see an example on the top of an income statement. First note, 3 lines. We identify the company, SoftBite, the name of the statement, income statement, and the period of time covered, in this case for the month ended September 30th, 2012. Let's look at the income statement first. It's simply a listing of our measured revenues, $4,700 in this case, less 4 expenses shown of salaries, rent, advertising, utilities expense totaling $1,950, and the net effect is net income of $2,750 for the month of September. Now, the owner's equity statement, as I mentioned before, is a broader statement. It incorporates the effect of net income, but it brings in the other 2 activities of investments by the owner and any withdrawals. In this case here, the business was started at the beginning of September when the owner's capital was 0. During the month, the owner invested $15,000. That's a plus. The business earned $2,750. We add that to it for a subtotal of $17,750. And we subtract the drawings of the owner, $1,300, to come down to an owner's capital balance of $16,450. So the relationship of the net income statement to the owner's equity statement is that the equity statement includes the results of operations plus other activity. Effectively, we see all 4 activities of the equity section. I'm referring to VERA, Vera, investments by the owner, $15,000, expenses or revenues net to $2,750, and the A, the takeaway, is the drawing account of $1,300. So the owner's net worth went from 0 at the beginning of the month when the business had not been created yet to $16,450 at the end of the month. Recapping the owner's equity statement at the top of this slide, it shows that the ending balance in owner's capital, $16,450, becomes a component of the 3rd financial statement, the balance sheet. And first, let me point out that the balance sheet on the bottom here, entitled as such, says September 30th, 2012. Not for the month ended, but at September 30th, 2012. In other words, it's a listing of ending balances in all our asset accounts, the ending balance in our liability account, and the ending balance in our owner's capital account. That ending owner's capital of $16,450 must be developed first before the balance sheet is developed. The balance sheet total assets equals $18,050, and the combined total of all liability accounts and the owner's ending capital account also totals $18,050. The balance sheet is in balance as it should be. And lastly, showing the relationship between the balance sheet and the statement of cash flow. Our ending cash balance was $8,050. That will be explained in the last statement, the statement of cash flow for the month ending September 30th. So the statement of cash flows is a statement of activity, just like the income statement was a statement of activity, just like the equity statement was a statement of activity. And so we're showing why cash changed during the month. Cash is a very important asset, and therefore it has its own statement. The statement of cash flows is a financial report that will not be covered in detail in this course. Just indicating the purpose of the statement of cash flow. Where did cash come from? What was it used for? What's the ending balance? Question: which of the following financial statements is prepared as of a specific date? Answer A, the balance sheet. That's a snapshot of ending balances. The income statement, the owner's equity statement, and the statement of cash flows cover a period of time, and the balance sheet is a snapshot of ending balances resulting of the activity in the bottom three statements. This slide begins to recap some expanded definitions of assets and liabilities. Again, an asset is a resource controlled by the entity. It's the wealth of the business. And as such, that wealth has future economic benefits that can flow from it. That is the ability to make additional sales and create new assets through those sales. A liability is a legal debt of the business, and most liabilities will be evidenced by an account with the last word payable, such as accounts payable or notes payable or mortgage payable. Definition of equity: a residual interest in the assets of the entity after deducting all its liabilities. That category defines the net worth of the owner in the business, the recorded net worth. In terms of income and expenses, income is a broad term which incorporates the term revenue, meaning that it's a measurement of why assets increase due to sales activity. Expenses, reasons why assets, that is, economic benefits, decrease during a period of time related to operating the business. The net of income less expenses is the net income. If expenses exceed income during a period of time, the business will record a net loss during that time period, as opposed to net income. If a net loss were experienced, that means that the asset base has shrunk due to the profit-seeking activities, not producing profit, but producing, in effect, a loss. This slide indicates that the U.S. accounting standard setting body, the FASB, the Financial Accounting Standards Board, and the International Accounting Standards Board, headquartered in London, are working to converge their accounting standards. And presently, U.S. companies are responsible for complying with U.S. GAAP, not international standards. That is expected to change in the next 2 to 3 years.